Hey traders and investors, it's Serge Berger here. I got a lot of questions over the past, really the past week or so on the Russell 2000, and I know I've covered this a little bit over the past few weeks, but I think there's a common misconception on when it just becomes, when the bottom is about to fall out on this market, and quite simply, we're currently at a pretty good spot, even if you just look back to like late 2012. We can draw some very straight support lines, and you can see essentially the Russell here has broken a lot of stuff. It's currently meandering around the 200-day moving average, which a lot of people used as an important reference area, rightly so, until it stopped working. Unfortunately, a lot of people are still using that point. I'm not quite sure. It's become just a choppy area, so the 200-day moving average basically is useless right now for those focusing on this day to day. Maybe on a weekly basis that'll have a bit of a bigger impact. But essentially, this index is not broken until it's broken in terms of price action in the near term. So if we draw a very simple support, this is the IWM that we're looking at here, which is the ETF on the Russell 2000. I'm using this one as opposed to the Russell 2000 because a lot of people use this as the trading vehicle of choice when you navigate the Russell. And basically, look, until in this ETF, the 107.50 is broken, you have an index that's still holding some sort of support. Now, I think at some point it will definitely break this, but I think right now the strategy, if you want to trade the Russell 2000 or if you want to base some sort of strategy around it, through the lens of at least a few weeks, you're best off, buying the dips and selling the rallies. And quite frankly, it's probably a higher probability strategy to sell the rallies. So we're seeing that again right now. Actually, as I'm typing, as I'm recording, as you can see, Russell's again under a little bit of pressure so far after just being up basically for 2 days in a row. So it's sort of, certainly the first index that's going to be looking heavy and in a top of a cyclical bull market, and that's again the case right now. But I don't think this is something you want to blindly short. You want to short this or sell credit spreads or something against this thing on a rally, not in a sell-off. I think that's, if I could sort of summarize my take on this, that's probably the biggest thing. There's also a head and shoulders pattern here forming. So basically, you have the left shoulder head and the right shoulder somewhere over here, which, by all means, we could build another one and go up as high as the 100-day moving average around 114.35, and then go back down again. So it's a higher probability strategy here to sell the rallies as opposed to selling into sell-offs. Hope this makes sense. As always, if you've got any questions, please let me know. Take care.